This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest monthly bonus podcast from the AJ Bell Money Markets team, all about investment trusts. My name is Dan Coatsworth, and joining me is Tom Sieber. Hi there, Tom.
Hello, Dan. We've got some really interesting stuff on this edition of the podcast. And unsurprisingly, the focus is on Trump's tariffs and how investment trusts have fared during the global market sell-off.
Now, later in the show, we'll hear from Ryan Lightfoot-Aminoff, who's an investment trust research analyst at Kepler Partners. Now, Ryan's going to be talking about investment trust opportunities in Asia, which is a hot topic as people start to look for ways to potentially dial down exposure to the US.
And I'll be talking to Jim Strang, who's the chair of HgCapital Trust, about the impacts of tariffs on the privately held tech companies in which this trust is invested, and why HG's focus on the more boring side of tech could stand it in good stead during choppy markets.
And Shares Magazine journalist Martin Gamble will be on the show as well. He's going to chat about the trust that was swept up in the global market sell-off in early April. But first, Tom, let's cover off some investment trust related news that we've seen since our last podcast. So should we start with takeovers? What's the latest we've got there?
Yeah, so it's been a bit of a common thread, hasn't it, for a while that there've been a fairly large number of takeovers in the space. So I'll run through some of the recent sort of more high profile ones. So the board of Harmony Energy Income Trust has recommended a cash offer from funds managed by the Foresight Group, which people might know the name. It's quite a big player in the renewable space, at a price of 92.4p per share. Urban Logistics REIT, which basically invests in kind of last mile, or what they call last mile logistics assets. So it's kind of the stuff quite close to delivery, has received a cash and shares offer from London Metric, valuing it at 150p per share. And it looks like the trust is minded to accept this offer. And the context for that is quite interesting because it drew some fire and engaged in a bit of a tit for tat exchange with a recently launched activist vehicle called Achilles. So that's the backdrop to that deal. Then you've got the landlords of GP Surgeries, a company or a trust called Assura Real Estate Investment Trust, which has accepted a 49.4p per share offer from two American private equity firms. And in doing so, it's rejected the overtures from its counterparts on the UK market, which is Primary Health Properties, which came in with a lower price bid, but was trying to sell the benefits to shareholders of a combination, given the assets were quite similar, and the approach of both was quite similar. And then a final one, AVI Japan Opportunity Trust has proposed a merger with Fidelity Japan Trust, but has seen that rejected. Now, subsequently, Fidelity Japan's board has said that it anticipates shareholders aren't going to approve the continuation vote next month, and therefore have begun a formal review of the trust's future. Within that, the long-standing manager, Nicholas Price, is set to retire later this year. So in effect, we're going to have something of a beauty parade, of which AVI Japan is set to play a part. So what they're going to do is open it up for somebody else to come in and manage the trust. What's interesting when you look at AVI Japan and Fidelity Japan, AVI is a value-focused investor, whereas the remit of the Fidelity Japan Trust has been much more about growth. So it'll be interesting to see how they resolve that.
So obviously we've got some trusts in takeover situations, but there are some others that are essentially throwing in the towel and liquidating their assets. So Tom, what's going on in terms of trusts that might be wound up?
Yeah, that's exactly right. So, seeing some shrinking of the investment trust universe, not just because trusts are being taken over or they're merging, but some are winding up. So one that could have gone in the M&A basket that, we were just talking about before is Aberdeen Diversified Income and Growth. But it's said now it's not going to proceed with an offer from an unnamed bidder, and it's going to instead sell its remaining assets, which are all kind of private market assets, under a managed wind down that was approved by shareholders last February. And it has said that the pricing for that will be at a material discount to NAV. And then there's been some new news in terms of wind-ups elsewhere. Ben Goldsmith, who is the son of the kind of well-known financier James Goldsmith, his Menhaden Resource Efficiency Trust, and then another trust, Miton UK Microcap, have received overwhelming shareholder backing for their own wind-ups. Both these names really struggled to achieve sufficient scale. Menhaden got off to quite a tricky start. Some of its investments have looked at a bit at odds with the strategy that they've been pursuing, and they basically just failed to get much traction with investors. So liquidation is, or, winding up the trust has looked like the best option. And then Miton UK Microcap hasn't really been helped by what has been quite long-standing poor sentiment towards UK small caps as an asset class, despite having some very experienced managers, so Gervais Williams and Martin Turner. Interestingly, their holders will have the option of rolling their investment over into shares in the open-ended fund Premier Miton UK Smaller Companies.
Okay, so obviously there's lots of changes going on there. And I thought, just to sort of wrap up this little segment, it's worth touching on some manager changes as well. Obviously, if someone buys shares in an investment trust, these are all actively managed products. And so when you have a change in someone who's making all those portfolio decisions, it's worth sort of taking notice to see who else is coming along. Are they sort of up for the task that is really required, to keep that investment strategy going? So is there any sort of managers that we're seeing changes which might be of a sort of noteworthiness?
Yeah, definitely. I think you make a really good point there. And the two that I'm going to pick out, sort of one, there's a bit more continuity, and the other, it looks like there could be a bit more change. So these are two fairly big names, certainly within the investment trust world, and they're set to exit the scene. Neil Herman, who has steered Henderson Smaller Companies since November 2002, which, for context, Dilemma by Nelly, featuring Kelly Rowland. Don't know if you're a fan. Dan was topping the UK charts when he took the helm. He's set to retire in September. But here, his co-manager, Indriati Van Hine, who he's worked with over the last 8 years or so, is set to take over. So you'd imagine, there'll be a fairly a bit of consistency in terms of the approach. The other name is Peter Hewitt, who has managed a fund of investment trusts. So basically a trust that invests in other investment trusts. It encompasses two vehicles with different strategies. So there's the CT Global Managed Portfolio Growth, and then CT Global Managed Portfolio Income. And he's managed both of those since their launch in 2008. And he's also retiring. He's being replaced by two people, so Adam Norris and Paul Green. And it does sound like there might be some changes afoot. So in the announcement around the succession, there was a reference to different perspectives on how the portfolio should be positioned relative to what Hewitt has been doing. So that does suggest they might look to kind of take a different path. Hewitt looks set to remain involved in the trust space, though. He was recently elected to the board of the Industry Body Association of Investment Companies. At the start of the pod, we said the episode would explore what's been going on with markets since the Liberation Day announcement. So before we get into the nitty-gritty of investment trust price performance, Dan, I know you've been looking at what AJ Bell customers have been doing with their portfolios.
Yeah, obviously it's been a very interesting time. We had, I don't know, about a week of quite sharp falls on most markets around the world, and then we've seen a sort of steady recovery. But looking at the trends of what AJ Bell customers have been doing, essentially the majority of them, have been buying all along, even during the sort of the big sell-off, which is I think is quite promising. It sort of suggests that people haven't been panicked by what's going on. They've seen opportunities to pick up things perhaps a cheaper price than seen in a while. Generally, there's been a real big interest in global equity tracker funds, US tracker funds, some individual stocks being, certainly sort of standing head and shoulders above lots of other ones, and that's been Nvidia and Barclays and Legal & General as well. I think there you could probably explain that Nvidia's made people lots of money over the last couple of years, and perhaps people hoping that if they can buy that a bit cheaper than it's been on sale for a while, potentially they, are they positioning themselves for a recovery in this stock? Things like Barclays and L&G is to do with valuation and dividends there. But in terms of investment trusts specifically, there's 5 names which stand out as being really popular ever since we've had that big Liberation Day announcement. And that's JP Morgan Global Growth and Income, which will obviously give you access to like a best ideas portfolio. Scottish Mortgage Investment Trust. So this is all positions itself as investing in tomorrow's market leaders. So this is, I guess that's interesting because that shows people still got a bit of a high appetite for risk if they're putting more money into Scottish Mortgage. Alliance Witan is sort of, again, it's another sort of best ideas of around the world. And then we've got Lord Debenture and City of London, and these perhaps more towards sort of income investors, sort of the appeal here, so a bit more to do with dividends and simply about capital growth. But it's names which continue to be popular. Just because we've had a bit of a market wobble, it's interesting to see. It suggests that people perhaps are, if they're investing regularly, same bit of money every month, they're just continuing with that investment plan. And overall, I think if you were to ask someone, what do I do during times of market strife? The general consensus is that it's all about time in the market, not simply trying to time the market. So sticking to a sort of a plan that you might already have. Time and time again, it sort of seemed to be deemed to be a one investment strategy, which hopefully should pay off down the line.
Yeah, that's really interesting. I mean, one of the names you mentioned there, Lord Debenture, has got quite an interesting structure, hasn't it? Because some of the sort of revenue they use to pay the dividend comes from a professional services business that isn't based on kind of underlying investments. They have this own business, which gives them perhaps a bit of resilience in terms of the income.
Yeah, absolutely. It's good. So yeah, I mean, it's really fascinating to see all these trends.
Absolutely. So thanks for that, Dan. Let's bring on our first guest. Last week, Dan sat down with Shares Magazine's education editor, Martin Gamble, to talk through various names in the investment trust space that were caught up in the Liberation Day global market sell-off, and to explore the ones that have bounced back. Clearly, markets are fast moving at the moment, and it's possible that certain trusts might have changed direction between the recording of this podcast and when you're listening to it. So just bear that in mind if Martin and Dan are talking about price trends in this interview you're now about to hear.
So Martin Gamble is with me now to talk about what's been going on with investment trusts. And I thought it'd be worth sort of splitting the periods into two, because between the 2nd of April and the 8th of April, we saw markets pretty much fall around the world. So I've taken that section, the first part analysis, and then looked at what's happened since the 9th of April, because markets have started to recover since then, certainly as we're recording this. So if we take the start, so 2nd of April, market close, everyone knew that Donald Trump was going to come out with this Liberation Day speech. So he made that speech, and then the following morning when markets reopened around the world, we saw really big falls. Naturally, pretty much widespread falls, but there were a few things that managed to buck that trend and actually went up. And among those was an investment trust called Ruffer. So Martin, I know from time to time you look at Ruffer and its peer group. So these fall under the sort of the definition of capital preservation trusts. What exactly is that?
Yeah, I don't. Yeah, they're kind of designed to protect, as it says on the lid, really, protect capital and grow capital over time. So they employ different strategies to do that. And so they'll allocate some of the portfolio to equities, and then there'll be a big portion of the portfolio they allocate to other types of asset. With Ruffer, they are very unusual in that they deploy tactics which the ordinary retail investor may not get access to. So they use derivative strategies. They invest in currencies like Japanese yen. So, and it's not really a black box, but they're a lot more sort of complex in the way they construct their portfolio, and they tend to be contrarian. So they wherever the market risk is, they'll try and put together a strategy to combat that risk. So in an event of markets falling or volatility rising, they hope to outperform and protect the capital through those times. And historically, they've done a very good job at that. If you look at all the past crises we've had during the financial crisis, COVID, they've generally produced positive returns during those market downdrafts. And the shares went up again, I think, during those early days of the Trump announcement. So they've potentially doing it again in terms of protecting capital.
And I think if you look at the list of trusts that fell during that 2nd to the 8th of April period, it's pretty big. But so at the top of the list in terms of the worst performers, we had trusts that are invested in Vietnam, trusts invested in China. Naturally, these two parts of Asia could be heavily hit by tariffs. And, we already know that China's been, perhaps worst hit. Now we've got a chat on this podcast all about Asia, so I won't go for this segment. Have a listen to what the chap from Kepler talks about Asia. But equally, we've saw some names like Manchester and London fall. So this is a tech-heavy trust, also Allianz Technology Trust as well. So naturally, when markets are falling, I think we see this risk-off mentality, and it's the idea that what's done well in the past won't always do well in the future. And so when markets start to wobble, people tend to, quite often will look at what's done really well and perhaps, okay, maybe it's time to take some profits off the table. Certainly when we have a risk-off market, it means that people aren't prepared to pay high multiples to access sort of high growth companies you might find in the tech sector. So that might explain why names like Allianz and Manchester and London were falling. But if you also, take a step back and then look what happened when markets start to rebound, there were some interesting trends, weren't there, Martin?
There were, yes. I think one of the interesting ones was the biotech sector, which had already fallen quite a bit. These trusts were trading at big discounts to their NAVs, and it was partly in response to JFK Jr. coming in to represent the sector in the US. We had up all of the healthcare services in the US, and there were fears that because of his anti-vax thoughts, and that he might stir things up, and it would be bad for the drug companies in general. And one of the trusts that did very well is IBT, kind of bounced back from being a very deep discount to being, I think, currently around 5-6% discount to NAV. And one of the catalysts for that was that the managers there put together a portfolio of smaller mid-type companies they think might be vulnerable to a takeover by big tech, big pharma. Excuse me. And in fact, during January, they received a bid for ITC at a 40% premium to the price that they held it. It's bought by J&J. So that helped sentiment in the NAV for them. And we saw a big bounce back in some of the biotech names because they were very, very well, very heavily sold during that initial period.
I noticed that there was the property space as well. There were names like Schroeder Real Estate. They did pretty well,
Yes.
as markets start to recover. Why do you think property was sort of moving higher then?
Yeah. Well, I guess, they were again heavily sold off, so they were trading at big discounts to begin with. So there was a lot of bad news priced in. And I think that part of the rationale could be that as people see the impact of the tariffs and the uncertainty it's creating in businesses globally, that could slow growth, not just in the US, but globally. And slow growth means the central banks may lower interest rates. And this sector is very sensitive to interest rates. So as the potential for interest rates to fall comes into view, then those discounts look a little bit anomalous with perhaps some help from the cost of capital. And they were basically, one of the reasons they were falling is because interest rates were rising post-COVID. So if that reverses, that headwind becomes a tailwind, and you're trading at a big discount, that could be seen as an opportunity by some investors. So the bounce kind of makes sense from that perspective, I think.
So we had, if you look, actually just rather than sort of segment it into certain time periods, if you just look at the whole period since the 2nd of April up until, I did this data up until the end of 28th of April. stuff that sort of really stands out, that sort of is either held up quite well or delivered sort of small gains, is definitely renewables. I think the idea that a lot of these are paying really big dividends. Some people might look at them and say, okay, these aren't linked to perhaps what's going on in the economy. We're going to need energy, and whilst energy prices could fluctuate because of what's happening in the economy, but these renewable sort of infrastructure sort of themed investment trust, they have been so out of favor for ages. So I think that perhaps people were looking at this sort of idea of, there's so much bad news already priced in here. And I guess they're sort of slightly linked to property as well. Do you think, is there an interest rate sort of angle on renewables that lower the rates is better for that sector?
Yes, it's a bit more complex for renewables because they've obviously, some of them have got, or a lot of them have an inflation component as well. So, but yeah, I think it's exactly the same argument as it is for property. The headwind from a higher cost of capital lowers the NAV, everything else being equal. So whatever happens, they've kind of up against this potential headwind. And as the interest rates potentially fall, they should gain from that. And the other thing that they've potentially gaining from is some self-help within the sector. So we had some bids come through, some of the smaller names which look more vulnerable, perhaps more open to some deals from private equity or other larger names in the sector. So that has also played a role, I think, in the recovery of those names.
Okay, and another.
And of course, their dividends are the dividends are also covered. So if you're looking for that dividend, it's pretty safe because it's covered by the actual earnings that they're making.
Well, I wanted to make a point about dividends actually. So I noticed that Merchants Trust had held up pretty well during this sort of broader sell-off. This is a portfolio of higher yielding companies, and I think that the idea, when we go through times of sort of volatile markets, a lot of people will look to their investments and say, like, okay, we might see the price of those investments go up and down, but hopefully those dividends should still be paid out on a regular basis. And unless the world really sort of goes into a bit of a nosedive in terms of economic activity and companies are forced to cut dividends, at the moment it looks like dividends will still be doled out. If you look at what's fallen throughout that whole period, 2nd to 28th of April, obviously Chinese stuff is understandable. People worried here about just how badly could the Chinese economy be hit by really harsh, very high tariffs from the US. Now, I saw that private equity trusts were slightly struggling here. Names like Pantheon, and this is actually quite interesting because at the sort of the low point of the sell-off, there was a really interesting research note from an outfit called Stifel. They were looking at different sectors and they flagged the private equity one looking quite vulnerable. And if you think here, private equity companies investing in lots of also unquoted businesses, and quite often they realize their returns when they sell their investment, or these investee companies will float on the stock market and they can see that as an exit to start selling down. Now, clearly, if markets are going through a sort of a very volatile period, it's very unlikely that we'll see lots of IPOs, companies coming onto the stock market for the first time. Also, it could delay sales to other parties, whether that's a trade buyer for the company in which they're invested, or whether a private equity company. They quite often sell stakes to other private equity trusts as well. So the idea here that we could see a bit of disruption to the flow of activity, and naturally that could sort of weigh on sentiment towards these private equity things. The Stifel note also sort of picked up on some other quite interesting things. They were talking a bit about biotech. So Martin, that's very much your sort of area of speciality. What were they saying there about biotech sector?
Yeah, they observed that historically there's a very close correlation between interest rates, the performance of interest rates, and the relative performance of the sector. And during that period that we're talking about now, there was a big disconnect as interest rates kind of came down, but the sector went to bigger discounts than what it would do naturally. And so they identified that as a big opportunity, despite some of the worries over tariffs for the pharmaceutical sector, which we know Trump has mentioned. And despite JFK Jr. being in charge, there's a potentially big opportunity, I think, for investors to get involved if they think that interest rates continue to fall, because that long-term relationship between interest rates and the valuations of biotech, if it normalizes, there's potentially an opportunity there.
Okay. And the other thing was they were flagging about global trust. And I think lots of people might have a global fund or a global equity fund or a global equity sort of based investment trust in their portfolio. It's an easy way to get exposure to companies around the world. But actually, if you look at some of these sort of global funds, they'll have a really big weighting towards big tech companies. And I think that, notably, the US stock market has lagged quite a lot of the rest of the world in terms of recovering here. Now, one of these global sort of equity funds stood out from the crowd when we were looking at the investment trust space, and that was Murray International. Now, this is arguably a bit more defensive style sort of exposure to global companies. I perhaps unfairly would call it exposure to sort of boring companies, but I think it's at times like now that might interest people who are looking to move away from sort of racier growth that's pretty expensive towards more value side. So, Martin, do you know much about Murray International?
A little bit, yeah. I mean, you're right. They're globally focused, and there's no Mag 7 in their top 10, 20 holdings. I can't see any Mag 7. And they attempt to grow the dividends as well ahead of inflation. So it gives investors maybe some comfort that those dividends are sustainable. And so the high yield you get, the value kind of focus that they're providing through their holdings could be attractive in a world where we just don't know what's going to happen from day to day. And they are defensive. I wouldn't say boring, and maybe it's boring for some. But yeah, the top holdings: Philip Morris, the CME Group, which is the exchange, which tend to be quite defensive. AbbVie in the health sector, the toll companies, Broadcom, Cisco. So it's got some US names in there, but generally very diversified globally, which I think should protect investors if the US continues to be shunned by investors globally, who's basically, they've had a good run, haven't they, over the last 10 years, the US investors. So yeah, giving even some of that back, these trusts should do well.
Excellent. Well, Martin, thanks ever so much for coming on the podcast to this little run through about what's been happening with these investment trusts.
My pleasure. Thanks, Dan.
Thanks to Martin Gamble for taking us through those investment trust names. There's a lot to get through in this episode, so let's now bring on our next guest. Dan recently sat down over Zoom with Ryan Lightfoot-Aminoff from research group Kepler Partners to talk about Asia and why investors are now showing a lot more interest in the region as a result of Donald Trump's tariff policies. It's important to know that Ryan discusses various investment trusts in detail towards the end of the interview. Ryan is not giving any investment advice, and listeners or viewers shouldn't consider these to be investment recommendations. Let's now hear what he had to say about Asia.
So I'm pleased to be joined by Ryan Lightfoot-Aminoff, who's an investment trust research analyst at Kepler Partners. So Ryan, thanks ever so much for coming on the show.
Dan, thank you for having me. It's my pleasure.
I think the US, certainly the US stock market, has been a real big choice for investors for a long time. But it does feel like this year there's a bit of rotation. Investors are sort of perhaps looking elsewhere in the world for opportunities. Now, Asia is naturally high up the list, and actually it's really well represented by investment trusts. And just as I was doing a bit of prep for this conversation, I started to make a list of all the trusts that cover all parts of Asia, and it's incredible the number we've got here. I guess let's start the conversation by, can you sort of go through what the sort of the options are for investors, whether it's sort of get broad exposure or I know that there are some country specific choices as well.
Yeah, absolutely, Dan. You're quite correct. There's a really broad opportunity set for investment trusts in Asia. You've got everything from single country focused trusts, even the likes of Vietnam, which is quite a niche country, all the way up to those in sort of India and China, two most populous countries in the world, and then quite a broad range of trusts focusing on the wider Asia Pacific opportunity set. So there are some that focus on sort of more core exposure, so those big key markets, and there are a few extra in sort of the ASEAN regions, so like the Vietnams and Philippines, and also those focusing on smaller companies as well. So some really exciting small cap opportunities in the region. And then on top of that, we've actually got quite a few income trusts focused on the region. Now, the Asia region is not typically high up the list for those looking for income, but it does actually have quite a few trusts offering really sort of attractive yields in there. I think the reason why Asia does lend itself quite well to the investment trust structure is that sort of fixed pool of capital that offers stability to managers, which is quite helpful in a market like Asia that can be quite volatile, quite subject to flows, and has many countries in there that I think generate some very strong opinions amongst investors. This is quite demonstrated by the stat of last year, which has been the dispersion of country returns. So between the best performing Asian country and the worst performing, there was 60 percentage points difference. So if you were the wrong side of that trade, you can get absolutely carried out. And then with the flexibility the investment trust managers have got because of that fixed pool of capital, they can actually make quite sizable allocations. So you've got quite a few trusts that have really sort of swung the bat a bit on stocks that they do want to own, that they don't want to own, countries that they want to avoid, countries they want to go into. And you're seeing quite a broad range of different exposures within that. I think pull out a couple of examples. Maybe we've got something like Schroeder Asia Pacific, which has outperformed through like really good stock selection, even though it has got quite notable differences in its relative allocations. So the managers are not biggest fan of some of Chinese companies because of the sort of corporate governance concerns, the wider state-owned issues. So they've been underweight the country. That's held for much of the 5 years going back. But then they've seen that actually there are lots of attractive elements to the Chinese market that they want to get exposure to. So own lots of, sort of Hong Kong companies, which kind of balances it out. It's very similar exposure without those sort of corporate governance concerns. Going a bit further down that line, you've got something like Pacific Assets, which is willing to pick completely on a bottom-up basis without any real reference to the impact index. In fact, the managers benchmark themselves against inflation rather than like an Asia Pacific index. So that's resulted in some really big allocations. Sort of in the last year, they've had allocations to China in the single digits when it makes up around sort of what has been as high as sort of 33, 40% for Asia index. They've had almost nothing in South Korea, again, another really big country out there. And they've had over 40% in India. So really leaning into that sort of quality, attractive demographics thing. And then also we've got those offering exposure to smaller companies, which we sort of touched on earlier. They are often considered a really high risk area, but because of that fixed pool of assets the managers have, they are able to invest in that without having to worry about inflows and outflows, and then really capitalize on sort of the lack of research in the area. So somebody like Aberdeen Asia Focus is a bit of an uncovered gem, in my opinion. It's got a 3-strong management team. They've got a huge amount of experience and resource for investing in that Asian region. And they've constructed a really highly differentiated portfolio that's delivered like really good outperformance that holds some really exciting stocks that you wouldn't get elsewhere. So something like FPT Corp, which is a Vietnamese company linked to the AI train. It's sort of like computer training, but has really benefited from being associated to NVIDIA over the last few years. Many investors wouldn't know about it at all, wouldn't have captured those gains. And also those smaller companies are very focused on the domestic consumer, so sort of the ongoing growth within Asia itself, rather than just sort of the old traditional way people saw it as a manufacturing hub for the rest of the world. So yeah, all in all, a really sort of broad range of trusts, even though the actual sort of numbers are quite concentrated compared to other vehicles you may get. And then at the moment, because of all these sort of geopolitical issues, almost every Asia trust is trading at a discount at present. So it's a really good sort of potential entry point for investors.
Yeah, because I think one of the reasons why people are looking for alternatives to the US is because of what's happened with tariffs. But equally, it's not like Asian companies are going to be completely exempt from tariffs. I mean, clearly, China's right in the hotspot here. As we're recording this, obviously the news seems to change every day about what these tariffs are, and by the time you hear watch this podcast, it's going to who knows where we're going to be at. But I mean, tariffs have got to be the big question mark, and the fact that, like you say, that many of these Asian trusts are trading at discount means that the market is worried about something. So how could someone who's trying to look for alternatives, perhaps to America, trying to get their head around tariffs? I mean, is there maybe could we start with Vietnam? Obviously, this is you mentioned earlier. There's quite a few different trusts for this region. Now, Vietnam was meant to be the alternative to China, a place where countries, sort of companies have sort of set up business. They, lots of manufacturing there. But as things stand, they could be in the firing line for really high tariffs. So what can an investor do?
Yeah, it's certainly difficult, and the headlines aren't helping. There's a couple of factors around Vietnam. Like you said, it's part of that we call the China plus one supply chain. So where people really went off China during the pandemic, Vietnam sort of picked up the mantle as like the more manufacturing hub, and it's slightly distant and kept away from the first round of tariffs. But it's now been singled out quite notably for very punitive tariffs under the regime that was announced and has been currently suspended. It's worth noting, though, that Vietnam is actually a very small percentage of the overall index. So for those trusts focused on the Asia Pacific index, it doesn't actually feature in the benchmark at all. So it's only really an issue for those who are going off benchmark, or for those who have Vietnam in their benchmarks, smaller companies, etc. The country has actually got a lot of very strong reasons to invest in it. It's got a young, dynamic population, supported by a really high level of spending by the government on things like infrastructure. So it's actually a really exciting opportunity in the emerging and frontier space. And all of those things are unlikely to be reversed in really a maximum of 4 years of US tariff issues. I mean, if you are a company starting out today and you're told, right, what are you going to go and build? Are you going to build a factory in the US, which is going to take minimum 3 years to build, get your permits, get up to speed, and then the whole tariff regime could be very different by the time you're actually opening and running, or somewhere in Asia where that existing infrastructure is there, the port networks are there, the rail networks are there, and the workforce is there to do it. So that it's not exactly great news for the region, but equally sort of the tariff regime is quite bad news for everyone, really. So Asia has an awful lot of strengths. It's got some really good structural drivers, great demographics, and then also world-leading companies that are already there. So I don't think this tariff regime, depending on whatever form it comes in, how this sort of 90-day hiatus works out, is going to ultimately curb the growth opportunity of the region.
Yeah, I mean, something like India, I mean, if I'm right in saying, is a lot more reliant on domestic activity rather than like a full export sort of led economy. So I guess if investors are a bit sort of perhaps worried about what's going on with the tariff stuff, obviously one option would be try and look at a broad range, not have too much reliance on one particular country. Could be one option, but equally could. Are there obvious places in Asia which are, might be less affected by tariffs than others?
Yeah, I think the broad theme that I think is good to take away is that some of the individual companies in Asia are not just also brands, they are industry leaders. So the companies like TSMC, Taiwan Semiconductor Manufacturing, are the absolute leader in making fabulous semiconductors. They have a huge economic moat. Nobody is going to, with all the money in the world, not be able to go and replicate what they do within a scale of 4 years. So the opportunity to go and challenge them and take on and start stealing market share from them is very unlikely to happen. So these firms are very prevalent in Asia. The region is not just a manufacturing hub for the world. It's not just about like low-cost labor to make goods for the West anymore. I think the stat I read recently is that of China's economy and thing, about 5% relates to exports to the US. So that's still 95% of their entire economy is focused on other things than what is dominating the headlines at the moment. So there's a huge opportunity set, not just within China, not just within Taiwan, but across the region of industry leading companies focused on very different markets to what is potentially affected. Touching on India, like you said, there's HDFC Bank, which is one of the leading private banks in there, taking market share of some of the state-owned enterprises. And that the sort of investment case for HDFC is based on the growing wealth and financial inclusion of the absolutely enormous Indian population. There are huge numbers, like millions of people join the workforce every day that are going to need bank accounts and start needing pensions and start using banking. And that is where HDFC are going to benefit from. those people joining the workforce is a demographic thing. You're not going to stand in the way of it, and you're not going to block it with a tariff on making tractor parts in the country. So these are all long-term structural secular drivers that are unlikely to be affected in the short term by the opinions and policies of US tariffs.
I mean, just finally, what sort of one or two of the trusts in Asia that really sort of catch your eye, that perhaps do something a little bit different to everyone else? Is anyone that stands out?
Yeah, I think there are a couple of areas we can touch on. I might even be as bold as to go for three possible examples. There's one area that has been an interesting development in the Asian region, actually, is the increased use of we call enhanced dividend strategies. This is where investment trusts are able to use income reserves and some contribution from capital to boost the income that it comes out. So one example is JP Morgan Asia Growth and Income. They've recently just increased their dividend amount by 50%. So they're yielding around 6% a year, depending on the level of NAV from the region. But because the managers are focused on sort of growth stocks, and they've got like TSMC and Tencent in there, for example, big names that people will know, they're able to generate that capital growth. They're using a little bit of it to contribute towards the income. So investors are able to get a 6% roughly yield on a growth trust. So that really helps for sort of portfolio diversification benefits. For those who are in income, it could be a very different source of potential returns from something like that. On more specific trusts, so I think we're going to go, if I may, for sort of either end of the scale of potential investments you could do. Maybe Pacific Assets, which we touched on earlier, and then managed with their completely benchmark agnostic approach. They've got a really strong focus on risk, and they see this as the permanent loss of capital. So not like a relative weight to this country or that country. It's like, are we going to lose money potentially over the next 5 years? Like that's how they see risk. So they want to offer sort of sleep at night exposure to the region, which I know many investors are concerned of the risk of Asia. So this potentially is one avenue for them. This has been borne out in the numbers as well. They have posted positive absolute returns in 9 of the past 10 years. And in that 1 year they didn't post a positive return, they lost 2.7%, whereas a benchmark lost nearly 10%. So really strong performance in sort of down and challenged markets, and a great sort of risk option for investors. Then potentially one other holding that investors may consider is sort of going down the market cap spectrum. So it's a bit higher up the risk spectrum is something like Fidelity Asia Values. It's predominantly focused on smaller companies. The managers have a very contrarian approach. So they have sort of highly differentiated allocations. This has transpired at the current portfolio. They have an anti-tech positioning. So they have almost nothing in Taiwan, of which 80% of the Taiwan index is all tech companies. They've got big overweights, the likes of China, because they believe it's undervalued. And then also big underweights, the likes of India, because they think it's overvalued. And this means that it has very different positioning. So again, works quite well as sort of portfolio diversifier. And this could really help with returns. So while this was quite painful positioning in early 2024, we saw a big rally in China as the government announced some stimulus measures in late September, early October. Also, India started to roll off as well around the same time, as sort of very lofty earnings expectations didn't quite come through. And Fidelity Asia Values has done really well in this environment, as you'd expect. So if you held that in a portfolio with something more risk adjusted, or even against sort of the global portfolio, you've got really differentiated source of returns potentially. And yeah, I think those two trusts sort of go to show the sort of different approaches you can get in the Asian region. You can go for the really high quality names where you've got lots of family ownership, that Pacific Assets does, where they sort of invest in that 10-year sort of buy and hold horizon, or you've got the likes of Fidelity Asia Values, which is, I mean, the manager's quite patient and has been through all this before. He's like, I remember when India wasn't popular and now it's like top of the tree. I remember when China was everything and you couldn't do anything else, whereas now it's down in the doldrums, and I'm going to wait for those two things to swing back, because ultimately you are going to get what you pay for.
Yeah, excellent. Well, Ryan, thanks so much for coming on the podcast. It's been really fascinating to hear what you've had to say on Asia.
No problem. Thank you very much for having me.
Thanks again to Ryan from Kepler Partners.
Okay, so there's time for one more segment on this special edition of the podcast. And it's the turn of Tom to have a chat with an expert from the investment trust space. So Tom recently caught up with Jim Strang, who's the chair of HgCapital, to talk about tech, tariffs and more. So here's what Jim had to say.
Hi, Jim. Thanks for joining us on the podcast. Now, for those listening who aren't familiar with HgCapital, could you just give us a brief snapshot of the trust and what it looks to achieve?
Yeah, absolutely. So hello, everybody. So I'm Jim Strang. I'm the chairman of the HgCapital Trust. And HgCapital Trust is effectively a portfolio of software companies which are private. So HgCapital Trust is public, but everything that we have inside it are privately held companies, nearly all of which are in the software space.
Right. That's really helpful to sort of give people an indication of what you do and how you operate. Can I ask, I mean, we're talking about this in the wake of quite significant volatility in the wider financial markets. What, if any, impact does that have on the portfolio of assets that you own?
Yeah. Well, obviously, like front of mind question for everybody, us included. So if you think our portfolio is just over 50 companies that are all based around actually quite a narrow definition of software. So they're in 8 subsectors or clusters, as HG calls them, of activity, notably things like tax and accounting, ERP and payroll. And those are pretty quote unquote boring sectors. So they're resilient, because obviously, like if you're a company, you can't turn off your accounting software because that means your business is dead, basically. Yeah. So the underlying companies themselves are in resilient sectors. So what has actually happened is at the operating level, little. And obviously, like we're in a closed period, so I can't tell you granular detail of what's going on across the business. But generally, there has been very little impact, and that what you've seen, that's what we would call first order impact. So there's very little first order impact across the portfolio, and most private equity firms are sort of broadly saying the same thing, which is little first order impact. The second order impact, which is what happens to our customers rather than what happens to our own activities, nobody knows. So, I mean, what the companies are all doing is they've got the early warning radars turned on to the max, and they're trying to pick up signs of disruption in their customer base as to what that might mean. But so far, so good. So what we're dealing with, I guess, is the huge gyrations in the public markets are causing a lot of uncertainty. I mean, particularly amongst investors, and some uncertainty amongst businesses. But the actual sort of tangible impact of that, well, again, like talking to other private equity firms that I know and work with, we've not really seen it yet.
Right, that's interesting. So, I mean, you talked about, companies having their, warning radars on or whatever, but are you getting any sort of feedback from investee companies about any kind of impact at all, or are they doing anything, in order to sort of potentially mitigate any impact?
So, I mean, I guess like we're all services. So tariffs are all about goods. So we're the opposite side of that, right? So we're not directly seeing it. I think, again, the kind of businesses that we have as customers, I think what they are seeing and they are doing in this elevated uncertainty is just they're postponing decisions. So sales cycles are extending, major capex plans are being given a sort of an extra second layer of scrutiny, what you would expect, right? So that's definitely, I think, the general picture, which is totally unsurprising. Like uncertainty goes up, decision making or the speed of decisions goes down, and risk goes out the window. So that's what you are seeing. I think as well, the other thing that I think is a feature of us is because of what we do, we have a kind of we start each year with 97% of our revenues in the bag, because it's a software licensing model and those licenses are multi-year. So we're like very, very insulated from the effects of it. The things that we would be worried about would be customers failing, business failure, which has not happened yet, or just like a big challenge in acquisitions. Like you can't acquire new customers because they're just not taking any risk. But as I said, given the nature of the kind of things that we do, I mean, this isn't really discretionary spending for customers. It's more like compulsory spending. And in fact, in a world where your margins are under pressure, the stuff that we have in the portfolio generally helps companies become more efficient. So actually, there's almost like, if you think the world's getting more challenging, you need more of this stuff, not less of it, because that's what's going to provide the efficiency benefits that allows you to survive if there is any kind of disruption or downturn.
Would you expect to see any pressure on kind of the margins of investee companies in against the sort of backdrop you're talking about?
So, I mean, again, like the can't really comment on us because we're closed, but
Sure.
the HG portfolio has been like, it's been in this model, this archetype of investing for a long time. So we've seen this movie before of like big crisis, existential threat, and history tells us that the companies are very resilient to that, and so the software companies run on this thing called Rule of 40, and Rule of 40 is revenue growth plus cash margin north of 40. So
Sure.
you normally get sort of 20% revenue and 20% plus margins, and sometimes you get 50 or 60 if you add them all together. That's not breaking down. Now, the companies that buy the software, so like, we've got Visma as the big poster child investment for HG, which is a tax and accounting business that was originally based up in Norway. Now they could be selling to Volvo, or like a subsidiary or a supplier of Volvo in Stockholm. Now they're going to feel it for obvious reasons. But that's a real problem for them, not so much for a problem for us, because as long as they're still trading, they still need to do their accounts. So that's a good thing. And indeed, if they're trying to optimize working capital because things are tight, which they may well be, then they need more of what we do, not less of what we do. So that's what we're broadly expecting.
You've mentioned a sort of specific name in the portfolio there. Perhaps could you sort of discuss a couple more that give a bit of a flavour of HgCapital and the sort of types of things that you look to invest in?
Yeah, sure. So as I said, I mean, it's sort of very constrained. So people might think private equity is like everything under the sun. Not really. It's actually much more in tram lines than that. And we are very much sort of the extreme example, because it's not tram lines with HGT, it's a tram line. It's one single tram line, which is this software, cloud software and business services that are driven by technology. Been that way for a while. No signs or really any risk of it changing anytime soon. And as I said, 8 subclusters, so significantly dominated by ERP and payroll software and tax and accounting software. As I said, stuff that you can't really turn off, and every business really basically needs a version of it. Visma is the sort of the AHG's sort of poster child. If we on their tombstone, there will be Visma written on it at some point. Been in the portfolio a very long time, and it's like 18 or 19 years. It's 20 next year, and odds on it's going to have a great 21st party in a while. Grows faster now than it did when we bought it, or when they bought it, which is, so the compounding is incredible.
Yeah.
And it's an SME software tool. So basically, if you're a small, medium-sized company, you need an accounting package to run your company, Visma will solve it for you. So that's very obviously one. Other things we've got in there, we've got, what's a good example? So Access is almost very similar to Visma. So Access is a British company. It's based in the UK. Same thing, software for SMEs, and same thesis, which is lots of recurring revenue, grow by selling more stuff to your customer. So one of the thesis that HG has in its portfolio is called the Office of the CFO, and it is literally like, if you talk to a CFO and say, how many problems have you got to solve? There's like a bunch. There's accounting, there's HR or payroll, there's treasury, there's FX. There's a sort of a bunch of things. And what HG have done as a thesis is say, well, let's just go and be kind of the one-stop shop. So we can go into the CFO and go, okay, like, we can solve all your problems in a variety of different ways. We can solve all your problems. And that means, like, actually, in terms of the cash that you can spend, we're going to try and take quite a lot of that across the different businesses and try and bundle these things together. It's like grabbing wallet, to use the consulting term. So in terms of that, you've got things like Audit Board is a good example. So Audit Board is a US business. So HG is about 75% European, 24% US by domicile, off the court goes. And Audit Board is a platform that does the thing called Sarbanes-Oxley compliance, which is, if you're struggling to sleep at night, I recommend reading about Sarbanes-Oxley compliance. It is the dullest of the dullest, but you can't not do it. and it lends itself to a technology solution. So that's another one where you sort of phone up the CFO and go, we're doing your audit, or we're doing your accounting and your payroll. You now have to do the Sarbanes-Oxley stuff. We've got a solution for you. It's called Audit Board. Let's do that. So that's a good example. Stuff that's a bit off-piste, or other, not off-piste, but a little bit different. Howden. So Howden's an insurance broker based in the UK. And again, it lends itself a lot to digitalization and data, because insurance is kind of a data business. And also it's in that industry, one of the things that HG tries to do as a target is to what it calls automate workflows. So workflows are literally the processes that you have to do to get stuff done in any business. Many manual, lots of humans involved in these processes, and often good people that are in these processes are relatively expensive people to have in your business. So if you can sort of get operating leverage, so you don't need to keep adding more and more people to your business as you grow, and you actually use the technology to give you that ability to sort of capture more of the value as you grow, that's a really good thing. And so in insurance, that insurance business, that market has got lots of processes and workflows that lend themselves to automation, and Howden's a good example. So it's been going on this journey of continuing to drive its internal efficiencies through workflow automation and also scale up, right? So the other secret to the investment thesis is you try and identify areas to play which are fragmented. So like markets are all defined by the customers and the costs that are involved in serving them. And what you want to try and do is identify that niche or that subsector quite clearly, and then figure out where you want to attach yourself. So like, you don't want to attach yourself to the 20th player in any market, because to get to a leadership position would be kind of impossible.
Yeah.
You want to attach yourself somewhere in the top 5. And then if you kind of, if you can get to, you make the Olympic final to start with, and then you use acquisitions to build your relative scale to get onto the podium and maybe pick up a gold. And if you do that, that's going to be a good outcome.
Yeah, no, that's really interesting. I mean, you mentioned Visma there and how long it had been in the portfolio. What's the kind of typical, holding period for an investment, and what is the pipeline of new opportunities looking like?
Yeah, so holding periods can be quite lengthy, and the other thing around it, I would say, like with HG, when they're looking at investments, when they're kind of getting these things done, it takes a long time to get them done. So they are, again, like a myth buster. Like bank phones up, says, would you like to buy my company? You go, hurrah, great idea, let's go do that. It doesn't work like that. So normally, like average lead times from first sort of meeting a business to getting something done, 6 or 7 years. So lots and lots of time to figure out, this industry dynamic stuff and the attachment points, etc. And then on the journey, so it's very unlikely or unusual the journey is going to be less than 3 or 4 years. It's normally 5 or 6 years, and it can be a lot longer. And what the way the business has come at this, they've done a really good job of this, is realizing there are some businesses that fall into our portfolio where, frankly, you don't really want to sell them, because all you're going to do if you sell them is make somebody else a lot of money. So if you've got one of those, then actually what you want to do is hang on to it and just keep it compounding. Because as I said, Visma compounds up faster now, 19 years after it was first acquired, than it did back then. So why, if you think, like, if you'd been dogmatic and said, let's wait 5 years and sell it, the amount of value that you'd have given away to somebody else would have been eye-wateringly painful.
Yeah.
So don't. So we've normally got the 50 odd assets in the portfolio. There's normally a sort of a decent handful that are kind of going to be around for a while, like normal than the usual, because average hold period, if you look at the data for private equity, the average hold period is about 6 or 7 years. There's going to be a handful that they're in the HG portfolio that we're going to have for double that, and keep compounding, which is great.
And what about that sort of question about the pipeline? Yeah.
So actually, it's okay. So we had a meeting a couple of days ago. Pipeline both ways, in and out, is actually okay. I mean, because the board were like, this can't be great, but because we're kind of genetically cynical, but actually the pipeline's in a pretty good place. And part of it is because it takes so long. I mean, we're not waiting for a bank to phone up, and they're not waiting for a bank to phone up and say, like, this has been in the melting for a long time. And actually the sort of super high quality assets, they're still trading, right? Even broadly and across private equity, the super high quality assets are still trading. And what HG's been good with is it's got some really high quality assets, and so it knows what it wants, so it can sort of act with conviction when it wants to do something.
Yeah,
and equally when it wants to get liquidity, it's able to find buyers. Shareholders will know that, over the last couple of years, there's been about 40 odd transactions, one way and the other, which is like way outlying relative to industry.
So thanks there to Jim from HgCapital, and thank you to everyone who's listened to this special edition of the podcast. So we'll be back with the normal AJ Bell Money Markets podcast at the end of the week. Until then, thanks very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.